On May 24th, 2023, $750 million Nvidia jumped 26% after its earnings release, while reporting a 13% year-over-year revenue growth decline. How can a mega-cap stock jump nearly 30% in one day, and how is it possible when revenue growth decelerates? The answer is the AI boom. The company designs and builds semiconductors and chips that power data centers with the computation capacity to run generative artificial intelligence applications and large language models. The data centers are foundational to other large tech businesses such as Microsoft and Google, who want to meet the rush of demand by companies of all sizes for generative AI applications. Aside from the recent price rally, Nvidia's stock price is no stranger to big jumps in price thanks to similar technological boom cycles such as cryptocurrencies. As a matter of fact, in 5 years, the stock went from a low of $35 per share in 2018 to a high of $400, generating more than 1,000% return on the day of recording this episode. The question is, after a 5-year 1,000% gain, is it too late to buy Nvidia? Let's talk about that. I'm Hoda Mehr, founder and CEO of StockCard, and on this channel, I share detailed fundamental analysis and interesting investment stories. Before discussing Nvidia's fundamentals and assessing whether it's too late to buy the stock, let's point something out. If you are already investing in the broad market index ETFs, such as SPY or QQQ, you already have a big exposure to Nvidia. The stock is the 4th largest holding in SPY ETF and one of the largest stocks in the QQQ ETF. So no, it's not too late to buy Nvidia. You are already an investor if you are an index investor through your 401k or other similar accounts. You now need to ask whether you'd want direct exposure to Nvidia too. The stock has a few fundamental characteristics that can help you decide whether the company has more room to grow. So let's go through the stock's fundamental analysis using our usual fundamental framework. How and how much money the company makes on its top and bottom lines, notable changes and trends in top and bottom lines, its cash versus debt status and balance sheet strength, whether the company makes free cash flow or not, and how feasible is it to reach its current valuation. Nvidia makes money by selling computer chips that it designs and builds for other technology companies to run data centers, make video games and computers, and build autonomous vehicles. Interestingly, Nvidia does not manufacture its own chips. It works with the likes of Taiwan Semiconductor to make the actual chips. But the company develops the technological architecture and the software that makes those chips unique and powerful. There are two important fundamental characteristics in what we just discussed. Firstly, the company makes money whenever the rest of the tech industry needs to adopt new technology. When cryptocurrency processing needs more power, AI training needs more processing speed, and autonomous vehicles need more accuracy, Nvidia makes more money. The faster the world experiences these new technological cycles, the more revenue Nvidia generates. And secondly, the company doesn't own large manufacturing facilities that take billions of dollars to build, upgrade, and maintain. That means Nvidia enjoys a healthy 65% gross margin and 20% net profit margin. Fundamentally speaking, Nvidia has solid top and bottom lines, two important factors we consider when researching a stock. It's also important to notice that roughly 30% jump after the recent earnings report comes from the company's forecasted $11 billion revenue for the next quarter, up from the $7.2 billion in the year's first quarter, thanks to the AI boom. This means a strengthening of the top line, growth, and health of the company. Having a growing top line is good, but better is the company's ability to turn that revenue into cash. Typically, free cash flow is a good indicator that a company's business is working, and Nvidia doesn't disappoint. It generated $2.6 billion in free cash flow. On top of its cash-generating business, it has more than $19 billion in cash and cash equivalents on its balance sheet, against roughly $7 billion in current liabilities. Nvidia generates cash and has access to enough cash to invest in its future growth without any concerns. Talking about cash and balance sheet, there is a rather surprising announcement by the company's SEC filings. It has announced that it may sell up to $10 billion in new shares at some point, raising additional capital. It is surprising because of all the cash it already generates and holds on its balance sheet. Raising capital doesn't sit well with current shareholders because it increases the number of shares and dilutes the existing shareholders' ownership of the company. Most likely, the company is trying to take advantage of the AI boost to its market cap and authorize share issuance without worrying about the market's negative reaction if it was announced at any other time. My guess is that the new shares can be used to fund the repayment of its current debt, or Nvidia expects it needs much more capital and R&D expenses to stay competitive in the market, and that investment is much higher than the cash it has on hand and can generate in the future. Nevertheless, both reasons don't sit well with me and are red flags in my books. Aside from those fundamental metrics, the important question we should discuss now is whether the company deserved the 25% jump on the earnings release day and the follow-on price increases since then. Today, when I'm researching Nvidia, the company boasts a 200 plus price to earnings and 37 plus price to sales ratio. Forward price to earnings ratio of 53 times indicates that the company is expected to be more profitable in the future, but still these valuations seem quite extraordinary. To grow into 37 times price to sales ratio in 10 years, Nvidia must grow its revenue by roughly 43% annually, all else equal. Nvidia has grown by almost 30% per year compounded in the last few years, but is still 43% compounded annual growth is quite aggressive. Moreover, the generative AI market is expected to grow by 27% annually in the next 10 years. Even if Nvidia grows as fast as the market, it still has a 16% difference between the market growth and the required growth rate to grow into its current valuations. That is hard to do. Before summarizing Nvidia's fundamental analysis and discussing what we should do with the shares, Let me invite you to look up Nvidia's stock card to research the company on your own. I leave a link to its stock card in the show notes. Better yet, if you don't feel comfortable paying such a high price for Nvidia, we recently launched the generative AI stock list on a stock card, so you can find the stocks like Nvidia working in this rapidly growing industry. Type generative AI in the search bar and get the list. I leave a link to that list in the show notes too. Let's recap Nvidia's fundamental analysis. Revenue is expected to grow rapidly thanks to the AI boost. The company benefits from strong growth and net profit margins. Nvidia generates more than $2 billion in free cash flow. The company has more than $19 billion in cash and cash equivalents. However, it carries an equal amount of long-term and short-term liabilities combined. The company has announced a possible $10 billion capital raise, which can dilute current shareholders, and Nvidia's stock is extremely overpriced despite the AI boom. Knowing all that, what should we do with Nvidia's shares? I have no doubt Nvidia's stock price can and may go up in the coming months. That's how hype-driven stock prices tend to move. They go up until something disrupts their upward momentum. In the case of Nvidia, any new stock issuance, any disruption to the huge revenue forecast, competitors' announcements, or any supply challenges can qualify as a disruption, and then it can easily give back its 25% jump in a day. If you own Nvidia, as I do, taking some profit off is not a bad idea, especially if you have other or better investment options in mind. And then buy the stock back when it comes off the AI hype. Be careful that you may sell and the stock may still go up. You need to be satisfied that you took some profit, reduced your risk, and you can sleep better now. Remember, investing is a game of probabilities. The investment return is not an absolute figure. You need to consider how much risk you take to generate a specific amount of return and whether that risk is justified. There is a higher probability of losing money at higher valuations. So you'd adjust your return expectations, wait to buy the stock at a lower price, or move to another stock with lower valuation and higher growth potential. After Nvidia's big recent jump, the probability of decline goes up, and staying away the stock is a prudent strategy in my point of view. Also, remember, as we discussed at the beginning, if you are investing in SPY or QQQ index ETFs through your 401k or automated passive investing, you already have a massive exposure to Nvidia. Ultimately, you need to decide whether you are okay to chase the momentum and risk higher drop probabilities, or you prefer to take some profit off now and wait for the next cycle by adding the stock to your buy the dip watch list. I decided to sell my Nvidia shares, and if you were a role with our CEO portfolio follower, you must have received an update by now. I leave a link to my portfolio on the stock card if you want to follow it for future updates. Whatever you decide, please share your strategy in the comments so we can all learn from each other. I'll see you next time.